All right, hello again, everybody. This is Mike Rixey. I am the lead options instructor for NetPicks. I wanted to get a video out here over the weekend because we saw some very interesting price action going into the end of this past week. Thursday and Friday, we saw some key support levels broken, and that potentially sets us up for a very interesting stretch going into next week. I want to highlight some key levels that I'm watching going into next week, and then also take a look at a trade that we just put on here Friday afternoon, a trade that could potentially still be taken first thing next week. So I'll outline that trade for you in just a moment. Now, we're coming off of a stretch that markets have been incredibly focused on news. We've had a lot of big earnings numbers out. Last week, it was all about Apple and Amazon. We've had a recent Fed meeting. We had the jobs report out this past week. The markets have been dominated by the headlines. Now that a lot of that news is behind us, we can shift our focus back on the technicals. We're not looking at movement strictly based off of overnight gaps because of the news headlines that have been coming out. Now we can take a look at some of those technical levels that could lead and guide us here in the near future. And that's what I would much rather see happen. I would much rather focus on technicals versus guessing how the market's going to react to news. That excites me. I look forward to this upcoming stretch over the next few weeks, really the rest of the year. I'd be very, very surprised if this market just continued to plow its way higher the rest of the year. We've gone so long with no fear price back into this market. I think we're going to see some of that fear price back in. What we've seen in rates and bonds over the past week, with rates moving higher, with bonds very, very active, I think that spells trouble for equities in the near term. And if we continue to see rates moving higher, I definitely think that could be a catalyst for volatility moving higher. And that's what we want. As active traders, we want the volatility. We want the range. So we're seeing some very encouraging signs of better activity going into next week. From a technical perspective, if you take a look at the daily chart of SPY, in the videos last week, I highlighted some of those key levels that we were watching as support, and those levels broke going into the weekend. We started out last week looking at that magenta colored line. That was the 8-period exponential moving average. That broke. We then tested Thursday into Friday, we tested those green lines on my chart. Those are the 20-period SMA and EMA, and those both broke on a closing basis. That potentially opens up a window for a move down to the 50-period SMA and EMA. Those are the yellow colored lines on my chart. Those are sitting down at 440 and a half and then 439.65. Those would be the next areas to watch should we sell off early next week. If that happens, I would expect support to be found there. I'd be very surprised if we just broke right through those levels first try. I would expect the bulls to step in there, defend those levels, and potentially give us a bounce. But that gives us a decent little window to start the week. Right, we currently are sitting at 446.81. That gives us, a $6 move to the downside potentially to start the week. I would love to see that happen. Now, if it doesn't, if we just bounce right away to start the week, areas to watch on the upside, all those moving averages that we just broke on the downside become areas of resistance. I'm looking at anywhere from 449.89 all the way up to 451.50. Those would be areas to watch on the upside. And then the high from back on the 27th of July at 459.44. Those are going to be areas to watch as resistance should we rally right back to the upside. The volume was pretty darn good. Friday afternoon, we saw 100 million shares trade on SPY. Normally, I like to see between 80 and 100 million shares. If I can see that level reached, normally that means pretty good volume across the board on the option side as well. Makes life easier for us to get fills on trades. That was encouraging to see. We also saw the ATR, the average to range, break back above 4. I talked about that in the videos last week as well. That's also an encouraging sign. It's still at a low level, but as long as we start upticking there, it provides a much better market for us to be active in. And then the VIX closed above 17. These are all good signs, guys. Even though financial media is not going to tell you that, we love the activity. We love the better volume, the better volatility. It gives us more to do on the option side. So I think it's going to be a great stretch for us activity-wise in the very near future. What does that mean going into next week? What are we looking at? Well, in the videos last week, we talked about the flexibility that the reversal wave trader program gives us. It gives us a disciplined rule set that we can follow on every trade. We have disciplined rules that give us entry, target, and stop levels. It gives us a roadmap that we can follow before we ever get into a trade. We know where to get in, where to get out. That's a great thing. We also talked about the diversification that the system can provide. We can use the system on many different stocks and ETFs. We can utilize different expiration cycles. We can also utilize different option strategies. And I want to highlight that feature using DocuSign as the example. This is symbol DOCU. This is the 130-minute chart. This is our standard swing trading chart. Swing trading for us means holding anywhere from 3 to 20 days is very typical for us. Anywhere in that range is acceptable for a swing trade. Well, what we were looking at last week, we had our magenta color dots here. Right, you can see those dots, and we talked about those last week, how the middle series of dots, that's our entry point. We had our target level at the lower series of magenta dots, and then we had our stop up top. And if I pull up my data box again, my data window, you can see all of those levels to the penny right in that box. Entry, stop, target. You see those numbers right in this area right there. Well, when I see a setup like that, when I see the magenta dots, the system is telling me to put on a bearish position. That could mean a couple of different things. Normally people just look at that and say, well, if I want a bearish position, come in and buy a long put. You could. I wouldn't have a problem with it. The other option, or one of the other options that you have, is to come in and sell a credit spread. And like we talked about last week, all that means is I'm just trading two options at the same time. The benefit of a credit spread is I potentially give myself 5 ways of making money versus only having one way of making money with a long put. Now let's take a look at both. That way we can just kind of compare and contrast here what those trades look like, what would be required, and what you can potentially make off of that trade. So the entry point was at 52.23. That level was hit. You can see we did close just below that level Friday afternoon. So if I jump over to the trade page, if I just wanted to buy the strict long put, it would be the most aggressive route to go. It's going to give me one way of making money. I'm solely focused on the stock moving lower. If it does, if it moves to the downside quickly, you're going to make the most money from that trade. It also comes with the most risk, because if the trade doesn't move in our favor, or if it doesn't move fast enough, the time decay is going to hurt as well. It is more of a high risk, high reward type of scenario. If you're okay with that, that's fine. The benefit is it's still a risk-defined trade. When you buy a long put, your risk is limited to whatever you pay for that option. Let's go out to the September 1st options. Those are the weekly options that have 27 days left to expiration. When I buy a long option, I'm typically looking for between 20 and 40 days left to expiration. That way, even though I'm only looking to hold for a couple of days at a time, by going out 27 days, I do limit the time decay somewhat. It's still there, but I can limit the impact right off the bat, just in case the trade takes longer than expected. And if I come in and take a look at a long put, ideally I'm going to lean slightly in the money, potentially looking at that 52 strike, the 52 or 53 strike. There's a little bit better open interest on the 53 strike. So if I went and bought the 53 put, going into Friday's close, you were talking about around $330 per contract. Pretty reasonable. It's nothing outlandish. You don't need a 6-figure account to take this position. You can definitely take multiple contracts, certainly. And it's an aggressive trade, meaning you have to see the stock move to the downside quickly, right? If it does, you're going to see a larger return, potentially in that 50 to 100% range is very doable on a long put. If you wanted to be a little bit more conservative, what else could you do? Well, this is where I love the credit spread. I like the more conservative nature of a credit spread, especially in this market, because let's face it, so far this year, we've had very little follow through on the downside. Every dip has been bought up pretty quickly. If I went out, and this is a trade that we took with our members on Friday afternoon, we came over and we sold the 53-55 call spread in the September 1st options. You can see the trade loaded up at the bottom. All that means is I'm selling the 53 call, I'm buying the 55 call. We actually got filled on this trade Friday afternoon at 65 cents. By collecting 65 cents, I was collecting that money up front to open the trade. It meant I was risking $135 to make 65. The benefit here, remember, the long put, we're talking about $330 a contract. The call credit spread, you're talking about $135. Lower risk right up front. The trade-off here is the long put has unlimited profit potential. The call credit spread, the most I can make is $65 per spread. It's a lower risk, lower reward type scenario. Why would I be interested in that? Because I would have 5 ways of making money. I would make money from all 3 directional moves, up, down, or sideways. I'd be okay in all 3 as long as price stayed below 53. That's the strike price of the option that we sold. I also make money from time decay adding up. Every day that passes, that's now helping me versus hurting me with a long option. And I could potentially make money from volatility decreasing. Any of those 5 work out for me. If we just kind of chop sideways, if we don't get that big move lower, I would be fine with that. The credit spread would still work out in my favor. On my target, The max profit is whatever I collect to open up the trade. Again, $65 per spread. The only way I can make that entire $65 is if I hold all the way up to expiration. I don't like to do that. I like to close the trade out early, take the profit, free up that capital, and move on to the next trade. So what I would be looking to do is to buy the spread back for between 50 and 75% of the max profit. 50% of max profit would have me looking to buy it back for 32 cents. 75% of max profit would have me looking to buy back at 16 cents. I would see that happen the quickest if we got an immediate sell-off. That's going to put me in a profit right away. If we don't see the immediate sell-off, I can still make it work. I just have to hold longer and let more time to add up in my favor. The next question becomes, which trade do you go with? Is it the long put? Is it the call credit spread? They're both valid. It just depends on how aggressive you want to be. I like the call credit spread here. I like the more conservative nature until we start to see more evidence of this market showing some follow-through on the downside. That's the beauty here. If there's times that I want to be more aggressive, I can look at the same trade and just take it with a long option. If I want to be more conservative, just depending on what's going on in the market, I can always go to the credit spread. Having that flexibility is huge. It allows me to react to different types of market conditions. That way I'm not just swinging for the fences on every trade. There's going to be a time and a place for that approach, but there's also going to be a time and a place where we have to be more conservative. The market just isn't giving us clear direction, and that flexibility is going to give you much better consistency over time. In worst case scenario on the call credit spread, I'm out $135. So just like the long put, it's still a risk-defined trade. I like that feature right up front. I like to know what my max risk is, especially in today's market where all it takes is one headline and things are thrown into chaos. I'd like to minimize my risk as much as I possibly can. Either way, you can certainly take the trade with one contract, one spread, or you can bump it up. You can take this trade with 10, 15, 20 contracts. It just depends on your account size. A lot of flexibility to scale as well. All right, so I would love to have you join us here next week. We are going to be doing 2 webinars on Wednesday next week. Wednesday, one at 12 o'clock Eastern time and then one at 7 p.m. Eastern time, where we're going to walk you through more details on the reversal wave trader program, both the swing trader mode and the active trader mode that we've been talking about here the last few days. We're also going to walk you through how you can gain access to the full system. I know a lot of you have seen the results here over the past week and the videos that we've been showing, and we'd love to have you join us for the next round of setups. Again, I'm super excited about what's to come here in the weeks and months ahead, and we'd love to have you join us with our reversal wave trading team. So again, you'll find a link in the description here of this YouTube video. We'd highly encourage you to reserve a spot here. We do expect full webinars both sessions, so we'd love to have you join us. And if you have any questions, concerns, if you have any trouble joining us for the webinar, let us know. You can always email me directly, mike@netpicks.com, and we can definitely make sure you get all the information that you need. So if you have not had a chance to go back and review the videos from earlier in the week, I'd recommend that you do so as well on our YouTube channel. We did have some very interesting trades that were closed out for some nice profits last week, and we'd love to have you take a look and give us some feedback. So you'll find those on the YouTube channel. I'm going to go ahead and wrap it up here at this point. I'll be back with you guys again next week with some additional videos. If you have any topics that you'd like covered, any markets that you'd like us to take a look at, let us know. We can try to take a closer peek there. So enjoy the rest of your weekend, guys, and we will talk to you all next week.